The 2008 financial crash wiped out $11.9 trillion in global wealth. It triggered mass unemployment in myriad countries and led to years of austerity and social unrest around the world. Governments spent trillions bailing out the banks, but millions of ordinary people lost their homes, their savings, and their futures. Politicians and economists called it a rare accident, a one-time financial disaster caused by a few greedy bankers, a black swan. But that's simply not true. Financial crashes aren't once-in-a-lifetime events. They happen constantly under neoliberal capitalism. And they are built into the system itself. Since 1971, the world has experienced 431 financial crashes, including 147 banking collapses, 218 currency crashes, and 66 sovereign debt defaults. Think about that for a second. Since the 1970s, the global financial system has collapsed every 2.5 months on average. The question isn't why 2008 happened. The question is, why does this keep happening? Because 2008 wasn't a mistake. It was the inevitable result of a system that has shifted from production to speculation, from real investment to financial gambling. In today's video at the Left Library, we're going to break down how capitalism's transformation into a financial system made this crisis inevitable, why governments bailed out the banks instead of fixing the economy, and why the next crash is already on its way. The 2008 financial crash didn't come from nowhere. It was the logical result of a system that had been changing for decades. To understand why 2008 happened, we first need to go back to the 1970s, when capitalism underwent a fundamental transformation. For most of the 20th century, capitalism was based on industrial production. The economy revolved around factories, manufacturing, and physical commodities. From 1945 until the early 1970s, this system delivered high economic growth, around 4%, rising wages, and relatively low inequality, at least in the West. This was called the era of embedded liberalism, when financial markets were strictly regulated and capitalist profits came primarily from real economic production, such as cars, steel, electronics, and consumer goods, not from financial speculation. But capitalism has a problem. It cannot stop expanding. And by the late 1960s, the room for expansion within industrial capitalism was running out. For 3 decades, industrial capitalism had delivered stability, relatively. Governments regulated financial flows during this period, they controlled exchange rates, and they kept investment tied to production. But by the late 1960s, cracks in this system began to show. The golden era of capitalism, as it later became called, had been built on a series of temporary advantages. For one, the US had dominated global manufacturing, while Europe and Japan were still rebuilding after World War II. For two, cheap labor and raw materials had been extracted from the global south, often under brutal imperialist conditions. And three, state intervention had kept markets stable, limiting financial speculation and ensuring steady growth. But by the late 1960s, all 3 of these conditions were beginning to break down. The West now faced fierce competition from Germany and Japan, who had reindustrialized and were challenging US dominance. Workers were demanding higher wages, cutting into corporate profit margins, and US military spending was out of control, especially with the Vietnam War, which drained billions from the US economy. And at the same time, global capitalism was hitting its natural limits. Markets were saturated, and the world was already filled with cars, appliances, and industrial goods. Corporations could only extract so much profit from manufacturing before running into a simple problem: who was going to buy more? For industrial capitalism, the 1970s were a turning point. Capitalist elites now faced a critical question: where would the next wave of profit come from? The answer to this? Finance. On August the 15th, 1971, President Richard Nixon made a shocking announcement that the US would abandon the gold standard. For nearly 30 years, global capitalism had been anchored to a fixed system of exchange rates, known as the Bretton Woods Agreement. Under this system, all major currencies were tied to the US dollar, and the US dollar itself was backed by gold. This ensured stability. Governments couldn't simply print money at will, and financial speculation was limited. But by 1971, the US was facing a deep crisis. The government had printed far more dollars than it had in gold to back them, fueling inflation and trade deficits. Foreign countries, seeing this imbalance, started demanding gold in exchange for their US dollars, but the US didn't have enough gold to cover these debts. Rather than admit economic weakness, Nixon unilaterally ended the gold standard, cutting the dollar loose from any real backing. For the first time in modern history, money itself became a floating, speculative asset. The entire global economic system shifted overnight from a world where money was tied to real commodities to a world where money was backed by only confidence in financial markets. And with this decision, financial capitalism was born. Now, there were no limits on how much money could be printed, how much capital could be moved, or how much speculation could take place. The consequences were immediate, and they would change capitalism forever. Ending the gold standard should have collapsed the US dollar. Without gold backing it, global investors should have dumped the dollar, causing massive inflation and economic collapse. But why didn't that happen? Because the US replaced gold with oil. In 1973, just 2 years after Nixon's decision, the OPEC oil crisis sent energy prices skyrocketing. The Middle East, rich in oil reserves, now held massive economic power. Rather than risk losing control of the global economy, the US made a deal with Saudi Arabia and other oil-producing nations. The US would protect the Gulf monarchies militarily. In exchange, all global oil sales would be priced exclusively in US dollars. This was the birth of the petrodollar system. By forcing the world to buy oil in dollars, the US created a new demand for its currency. Countries needed dollars to buy oil, meaning they had to keep US financial markets strong, even after the collapse of the gold standard. This, in turn, allowed the US to print unlimited money without suffering the consequences of inflation, because global markets were forced to absorb these dollars. This was the beginning of modern financial imperialism, where the US economy was no longer based on industrial exports, but on controlling global financial flows. And with this new system, the role of banks and corporations dramatically changed. Instead of investing in new factories or production, capital now flowed into financial speculation. The stock market became more profitable than industry itself, and with this, the era of financialization had begun. By the 1980s, Reagan and Thatcher would take this system to its logical extreme by deregulating financial markets, dismantling state controls, and creating a world where banks, hedge funds, and Wall Street ruled the economy. This was the moment where capitalism left industry behind. A new phase of the system had begun, one where capital no longer needed production to generate profit. It could make money from money itself, and in the coming decades, this shift would lead to bubbles, debt crises, and ultimately the collapse of 2008. So, by the 1980s, we're aware that capitalism had fully entered its new financial phase. The industrial economy of the post-war years, the era of factories, mass employment, and government-controlled finance, was disappearing. It was being replaced by a system where banks, hedge funds, and multinational corporations weren't just supporting industry, they were becoming the economy itself. The rise of financial capitalism wasn't accidental. It was the result of deliberate political choices, a shift engineered by world leaders, economists, and corporate elites. Governments, once committed to regulating capital, began dismantling the very rules that had kept financial speculation in check for decades. The justification? Free markets, deregulation, the so-called miracle of neoliberalism. The reality of this? A new form of capitalism built on debt, speculation, and an economy that no longer needed workers or production to grow. This was the era of deregulation and would set the stage for the 2008 crash. In the 1980s marked a profound shift in economic ideology. Under the leadership of Ronald Reagan in the US and Margaret Thatcher in the UK, capitalism underwent a radical transformation. For decades, financial markets had been tightly controlled. Governments regulated banks, prevented speculative lending, and restricted capital flows across borders. These protections had prevented financial crises and ensured capital was directed towards productive investment. But for the ruling class, this system had a problem. It limited their profits. In the 1970s, with industrial capitalism slowing down, corporations, banks, and investors wanted a way to maintain high returns, and they found their answer: remove the rules, tear down the restrictions, and unleash capital to do whatever it wanted. Ronald Reagan and Margaret Thatcher delivered exactly that. In the US, Reagan lifted controls on banking, trade, and capital markets, allowing finance to operate with no restrictions. In the UK, Thatcher privatised state industries, destroyed trade unions, and turned London into a deregulated financial hub. For the first time since the Great Depression, banks, hedge funds, and private investors were given free rein to do whatever they pleased. What followed was a financial explosion, one that completely changed the structure of capitalism. With regulations lifted, capital flooded into new, highly speculative financial markets. Banks and corporations no longer needed to make profits through industry. They discovered that they could make far more money by manipulating money itself. Finance became the new engine of economic growth. Banks were now free to lend without restrictions, creating a tidal wave of debt. Investment firms exploded in size, pumping money into stocks, bonds, and real estate speculation. Derivatives markets were born, allowing traders to bet on assets that they didn't even own. This was a complete break from the past. For most of history, banks existed to finance businesses and industry. Now, they were repackaging debt, gambling on markets, and inflating asset bubbles. Between 1980 and 2007, global financial assets grew from $12 trillion to $219 trillion, over 3 times the size of the global economy. But this wasn't real wealth. It was fictitious capital. Money making money, disconnected from the real economy of production and wages. And as more money flowed into speculation, the economy became less stable. By the 1990s, even the supposedly centre-left governments had fully embraced financial deregulation. When Bill Clinton took office in the US in 1993, for example, he continued the same neoliberal policies that Reagan had started, removing the last major restrictions on financial markets. The most disastrous of these changes was the repeal of the Glass-Steagall Act in 1999. Glass-Steagall had been passed after the Great Depression to separate commercial banks from investment banks. This meant regular banks couldn't gamble with people's deposits, reducing the amount of financial speculation possible. But under Clinton, this rule was abolished, allowing banks to become massive, unregulated financial conglomerates. And with this change, Wall Street banks could now gamble freely with public money. This led to a merger frenzy. Mega banks like JP Morgan Chase, Citigroup, and the Bank of America grew into massive financial institutions, controlling trillions in assets. For the ruling class, this was a golden age. The financial sector boomed, but beneath the surface, the economy was becoming a house of cards. By the 2000s, deregulated finance had transformed the entire global economy. Debt had become a primary driver of economic growth. You see that corporate debt during the 2000s exploded, household debt during the 2000s exploded, and government debt during the 2000s around the world exploded. At the same time, banks no longer made money from loans alone. They created complex financial products like derivatives, mortgage-backed securities, and credit default swaps. That allowed them to make bets on anything. This was the global financial casino, an economy no longer based on production, but based on endless financial speculation. But financial booms always have one inevitable outcome. They always end in crashes. The seeds of 2008 had now been planted by the early 2000s. With no regulations, no oversight, and a global financial system running purely on speculation, the economy had become a time bomb, waiting to explode. And when it did, the consequences would be catastrophic. By the 2000s, capitalism had fully embraced its financial phase. Deregulated banks, unregulated financial products, and the global casino of speculation had created a new economic model, one based entirely on debt. This was the secret of the global economy in the lead up to 2008. It wasn't driven by production, it wasn't driven by wages or industrial growth, it was driven by the creation of financial bubbles. The ruling class had found a way to keep capitalism going, even as real profits from industry declined. Instead of making money by investing in real businesses, banks now made money by creating debt, packaging that debt into a new financial product, and selling it to investors. Debt itself became a commodity, traded and resold for profit. A bubble machine designed to extract wealth from workers and funnel it into the hands of financial elites. And this wasn't an accident. It was the logical outcome of decades of deregulation, neoliberal policy, and the total transformation of capitalism into a purely financial system. And at the centre of this bubble machine was one key asset that everybody needs: housing. If finance was going to dominate the economy, it needed a foundation, an asset that could be endlessly inflated. And this asset was housing. By the early 2000s, home ownership had become a pillar of the financial economy. Banks no longer made money by simply issuing mortgages. They had to figure out a way to turn those mortgages into a financial product. It worked like this. A bank issued a mortgage to a home buyer. Then, instead of holding onto the loan, the bank bundled thousands of mortgages together into a financial product called a mortgage-backed security, or MBS. These securities were then sold to investors, pension funds, and global financial institutions. This way, the banks made their money up front, and investors got a steady stream of income from the mortgage payments. On the surface, it looked like a win-win. Banks could now issue unlimited mortgages without worrying about risk, because they didn't keep the loans. They sold them on almost immediately. This meant the more loans that they issued, the more money that they made. Enter the subprime mortgage explosion. And there came the problem. By the early 2000s, banks had already given out mortgages to most financially stable home buyers. So, to keep the bubble machine running, they had to find new borrowers. That's when they started pushing subprime mortgages, home loans given to people with low incomes, bad credit, or no financial stability at all. At this time, banks eliminated income verification, giving loans to people with no proof that they could really afford them. Also, adjustable rate mortgages were introduced. Low interest rates at first, but skyrocketing payments later down the line. This means that people who should have never qualified for a mortgage were handed loans, as long as banks could sell them to investors. This entire system became one giant debt trap. Borrowers were told, "Don't worry, home prices will keep rising. You'll always be able to refinance or sell." And for a while, that seemed true. Home prices surged to record highs because banks had pumped so much money into the market. With this, the housing bubble kept expanding, and the economy, on paper, seemed stronger than ever. But this wasn't real growth. It was a bubble built on financial trickery and always doomed to collapse. At this point, banks weren't just selling mortgages. They were creating new financial products to bet on those mortgages. Enter derivatives, a financial weapon that would turn the housing bubble into a global crisis. Derivatives are complex financial instruments that derive their value from something else: stocks, commodities, or in this case, mortgages. The most infamous of these were collateralized debt obligations, or CDOs. In a CDO, banks bundled mortgage-backed securities together and repackaged them as a CDO, making them seem like even safer investments. They mixed subprime mortgages with good mortgages, disguising the risk when selling them on to investors. Ratings agencies, who were bought and paid for by the banks, gave all of these toxic assets AAA rating, the highest possible grade. This allowed the bubble to grow even bigger, as investors poured billions into financial products that were essentially time bombs. But the banks still weren't satisfied. They wanted to bet against their own products. So they created credit default swaps, or CDSs. CDSs are a way to place bets on whether mortgage-backed securities would fail. This meant that banks were profiting from selling bad mortgages while also profiting from betting on their collapse. It was pure financial insanity. And when the housing bubble finally burst, it wouldn't just wipe out homeowners, it would bring down the entire global economy. By 2006, cracks in the system started to appear. Home prices, which had been rising for years, started to level off. Then the impossible happened. They began to fall. Suddenly, the entire logic of the financial system collapsed. Homeowners couldn't refinance their loans because prices were dropping. Subprime borrowers began defaulting in massive numbers. Banks, which had gambled everything on the idea that housing prices would never fall, started losing billions. As panic spread, investors pulled their money, and the entire financial house of cards began to collapse. By 2007, major lenders like Countrywide Financial and Bear Stearns were on the verge of bankruptcy. By 2008, the collapse had reached the Lehman Brothers, one of the biggest investment banks in the world. On the 15th of September 2008, Lehman Brothers declared bankruptcy, triggering the largest financial crisis since 1929. In a matter of weeks, the global financial system shut down. Stock markets crashed, credit markets froze, and trillions of dollars vanished overnight. This wasn't just a housing crisis anymore. It was the collapse of financial capitalism itself. But the financial collapse of 2008 wasn't a random accident. It was the inevitable result of a system built on debt, speculation, and financial bubbles. Banks had rigged the economy, funneling billions into a system that was always going to collapse, while leaving ordinary people to deal with the fallout. And as we'll see in the next and final part, when the crash finally happened, the entire system wasn't just bailed out. It was rebuilt to be even bigger, even riskier, and even more dependent on financial speculation. By September 2008, the global economy was in freefall. The housing bubble had burst, mortgage defaults were rising, and banks, who had built their entire business model around bad loans, were facing massive, unrecoverable losses. For years, financial institutions had lied about their risks, repackaging toxic assets into safe investments. Now, as those investments collapsed, they were forced to admit the truth, that they had no money left. What followed wasn't just a crisis in housing or finance, it was the near collapse of capitalism itself. Credit markets froze, meaning businesses couldn't borrow to cover basic expenses. Major banks faced bankruptcy, threatening to wipe out savings, pensions, and investments overnight, and the stock market plunged, erasing trillions in wealth. And in this moment of total disaster, the US government had a choice. Let the financial system collapse and risk a total economic depression, or step in and bail out the banks, rescuing the very people who had caused the crisis in the first place. They chose the bailout, but not for you, not for the millions of people losing their homes, not for the workers facing layoffs. The only people who got saved were the banks and the financial elites. This is the story of how capitalism imploded, and how, instead of being punished, those responsible were handed trillions in public money and allowed to keep their power. The breaking point truly came on the 15th of September 2008, as the Lehman Brothers, one of the largest investment banks in the world, declared bankruptcy. They had $600 billion in assets on paper, but most of it was worthless mortgage-backed securities. They had leveraged themselves to dangerous levels, borrowing $30 for every $1 they actually had. The moment investors realized that Lehman couldn't cover its debts, the bank collapsed overnight. But this wasn't just one bank going under. Lehman Brothers had deep financial connections with banks around the world, and their collapse triggered a global panic as investors rushed to pull out money off the system. The Dow Jones dropped 500 points in a single day, its worst decline since 9/11. Other major banks such as Merrill Lynch, Citigroup and AIG teetered on the edge of collapse, and governments around the world scrambled to contain the fallout within their own national economic borders. But one thing was clear: the financial system was built on a web of interconnected debt, and if one major institution fell, they could all go down together. Within days, the global economy was spiraling into an abyss, and that's when the US government stepped in. But this help wasn't, again, for ordinary people. They were there to save the bankers. With the financial system on the verge of total collapse, US officials put together an emergency rescue plan, the Troubled Asset Relief Program, or TARP, a $700 billion bailout for Wall Street. The idea was simple: the government would buy up bad assets from the bank, giving them cash to stay afloat. The Federal Reserve would also pump trillions of dollars into the financial system, providing liquidity. The goal? Stabilize the economy before the crisis spread even further. But again, let's be clear that this wasn't a bailout for ordinary people. It was a handout for the financial elite. Because while banks were given massive amounts of public money, millions of ordinary Americans and other nationalities around the world were left to suffer the consequences of the crash. 8 million jobs were lost in the US, 10 million families lost their home to foreclosure, and household wealth in the US collapsed by $16 trillion. Meanwhile, the CEOs of the banks responsible for the crisis walked away with bonuses. Lehman Brothers CEO Richard Fuld earned $500 million just before the collapse. Goldman Sachs, despite receiving bailout money, paid out $14 billion in bonuses a year after, in 2009. Citigroup and AIG executives rewarded themselves with multi-million-dollar bonuses just months after being saved by taxpayer public money. This wasn't a financial rescue, It was a transfer of wealth from the public to the financial elite. This was capitalism working exactly as intended. When profits are high, the rich keep everything. When their reckless speculation destroys the economy, the public always pays for it. The system wasn't broken. It was doing exactly what it was designed to do. And the effects of the 2008 crash weren't limited to the United States. Because global finance was so interconnected, the crisis spread worldwide, and the response was the same everywhere. Governments bailed out their financial sectors, then turned around and told the public they had to pay for it through austerity. In Greece, government spending was slashed, leading to massive job losses and skyrocketing poverty. In Spain and Italy, public services were gutted, while employment hit record highs. In the UK, austerity policies led to deep cuts in healthcare, education, and social programs. Everywhere, the message was the same. There's no money for public services, we have to cut spending, ordinary people have to tighten their belts. But there was always money for the banks. The US Federal Reserve pumped over $16 trillion into financial institutions through various emergency lending programs. Central banks in Europe did the same, handing out billions to stabilize corporate profits. Once again, capitalism had socialized its losses, forcing the working class to pay for a crisis they once again did not create. And as the economy recovered, one thing became clear. Nothing had changed. The same banks that caused the crisis were now bigger than ever. The same financial tricks were still being used, and the same elites were still in power. There were no criminal prosecutions for the people who crashed the economy. There were no reforms to stop this from happening again. Instead, the system was rebuilt on even shakier foundations, setting the stage for the next crisis. After the 2008 financial crash, governments and central banks stepped in to save capitalism. They didn't fix the system, they didn't punish the guilty, they didn't change the financial rules. Instead, they pumped trillions into the financial sector, hoping to keep the bubble machine running, and it worked for a while. Today, financial capitalism is bigger than ever, but so are the risks. Global debt has exploded to over $300 trillion, higher than any point in history. Financial assets now exceed $1 quadrillion, money that doesn't exist in reality. And the rich have become richer than ever, while ordinary workers are drowning in debt and stagnant wages. The question is not if another crisis is coming, but when. Because the same forces that created the 2008 crisis are still in place. Only now they're even bigger, more fragile, and much more dangerous than before. And this system doesn't just experience crises, it needs them to survive. 2008's crash should have been a moment of reckoning. Instead, governments did what they always do. They bailed out the rich and they left the rest behind. But there was a problem with this. Even though the banks had been saved, the real economy was still in crisis. People had lost their jobs, families had lost their homes, and wages were still stagnant. And instead of investing in economic recovery, central banks pumped trillions into financial markets, creating the biggest financial bubble in history. Through quantitative easing, or QE, central banks printed money and handed it to banks, hedge funds, and corporations. This wasn't money for hospitals or infrastructure. It was money for workers or small businesses. It was pure financial welfare for the ruling class. The result? The stock market reached record highs, even as wages stagnated. Corporate profits have skyrocketed, even as real investment in industry declined. And the wealth of billionaires doubled and tripled, while workers struggled with rising living costs. This post-2008 has been financial capitalism on life support, an economy where growth came not from production, but from cheap money being pumped into financial assets non-stop. But just like the housing bubble of the 2000s, this new bubble was built on nothing real, and when bubbles expand, they always pop. After 2008, the ruling class needed a new way to extract wealth. With interest rates at historic lows, corporations borrowed trillions, not to invest in jobs or productivity, but to buy back their own stocks and inflate their share prices. The logic was simple. A company takes cheap debt, money borrowed at near zero interest rates. Instead of expanding production, it uses that debt to buy back its own shares, artificially inflating their company's stock price. And then executives, whose bonuses are tied to stock value, cash out, making billions without adding any real value to the actual economy. Stock buybacks became the main driver of economic growth in this post-2008 era. Between 2010 and 2020, corporations spent over $6 trillion on stock buybacks, more money than they spent on research, investment, or workers' wages. This was a stock market bubble in slow motion. At the same time, real estate became a new speculative asset. Instead of investing in housing for people, financial firms like BlackRock and Vanguard started buying up entire neighborhoods, not to live in, but to turn housing into a rent-extracting machine. With this, home prices skyrocketed, making it impossible for working-class people to afford a home. Corporate landlords also jacked up rent prices, forcing people to spend more of their wages on housing. And vacant luxury apartments in major cities became speculative assets for global investors, sitting empty while millions struggled with housing insecurity. And the housing market wasn't about housing anymore. It was a financial casino, with real estate serving as a store of value for the ultra-rich. And it didn't stop there. With cheap debt flooding the economy, even governments got in on the game. Instead of investing in public services, education, or healthcare, countries around the world borrowed heavily to fuel corporate subsidies, military spending, and tax cuts for the rich. Between 2008 and 2023, global debt exploded to over $300 trillion, an amount that can realistically never be paid back. And what had capitalism created? A world where the stock market wasn't about investment, it just operated as a rigged system for the elite. Where the housing market wasn't about shelter, it was a rent-seeking tool for the elites of financial capital. And the debt system wasn't about stability. It now operates as a way to extract money from the working class to keep financial capitalism alive. And just like before 2008, the ruling class pretended that this could go on forever. But bubbles always burst. By 2023, the cracks in the system were already showing. After years of artificially low interest rates, central banks were finally forced to act. Inflation had reached a 40-year high, wages had stagnated, and real economic growth was slowing to a halt. The Federal Reserve and other central banks raised interest rates in an attempt to cool down the economy. But this exposed just how fragile the system really was. Companies that had taken on trillions in debt suddenly found themselves unable to repay their loans. Regional banks began to fail, including major institutions like the Silicon Valley Bank. Stock markets also wobbled and debt payments soared, and recession warnings became louder and louder. It became clear that capitalism had learned nothing from its crash in 2008. The system was still built on speculation, still built on debt, still built on bubbles that had to keep growing or collapse completely. And the worst part? Every time capitalism destroys itself, it finds a way to make ordinary people pay for the consequences. As you should be understanding better now, capitalism has a simple rule. When the rich win, they keep everything. When the rich lose, they get bailed out. But when the workers lose, they get nothing. In 2008, the government handed trillions to banks while letting millions lose their jobs and homes. In 2020, the system collapsed again. And once again, trillions were pumped into the financial system while working people struggled to survive. So when the next crisis hits, do you really think they'll do anything differently? The same economic system is in place. The same financial elites are still in power. The same ruling class still controls the banks, the markets, and the policies that decide who suffers and who gets saved. This system cannot be fixed because it is not broken. It's working exactly as it was designed to. It's a machine for transferring wealth upwards, a system that privatizes profits and socializes losses, a capitalist order that only functions by creating periodic crises and then making the working class pay the price. If you take one lesson from 2008, then let it be this: they will do it again. The only real question is, what will we do about it? Because if we let another crisis pass without challenging the system itself, we are only ensuring that this cycle continues again and again and again. So, what do you think? Is another crash coming? Should finance be controlled by the public? Drop your thoughts in the comment below. If you want to learn more about the history of capitalist crises, financial speculation, and some real alternatives that we have to this system, then please do subscribe to the Left Library for more deep dives into political economy. And, as always, knowledge is power, so share it.